Are the British heading for an economic meltdown? With inflation still high, government debt piling up, and bond yields increasing, some analysts are warning of a triple slump as markets brace for the latest GDP data. Will there really be a simultaneous crash in the pound, UK stocks, and government bonds? Or is this just another case of exaggerated fear in the headlines? In the next 6 minutes, we'll break down the existing data, our forecast, and what it means for you. The UK's August GDP report is due on October 16th, and markets are expecting a modest 0.1% month-on-month growth. If that number holds, it would mark the country's third straight month of recovery after a sluggish spring. But the broader backdrop still looks tough. The UK is dealing with weak productivity, sticky inflation, record high debt, and rising bond yields. The government is also considering fresh spending cuts to stabilize the budget. Altogether, this mix has led to growing fears of a triple slump. If you'd like to see the data behind these insights, we've got you covered. Check out the link in the description. Now, with the big picture explained, let's now zoom into the individual factors, starting with the pound. Since July this year, the British pound has traded in a relatively tight range against the US dollar. On one hand, fiscal challenges are weighing on the pound. Chancellor Rachel Reeves estimates that the current budget shortfall could be between 20 and 40 billion pounds, and the UK government still hasn't announced a clear plan to close that gap. That lack of clarity makes investors nervous and puts downward pressure on the currency. On the other hand, however, the US Fed Reserve has already begun cutting interest rates, while the Bank of England is expected to move more slowly. As the gap between the two narrows, that could actually support the pound in the near term. When you balance all of that out, the actual odds of a sharp collapse in the pound are very low, which means GBP to USD is more than likely to stay range-bound. Volatile, yes, but the pound is definitely not in free fall. Next, let's talk about stocks. The FTSE 100 recently hit record highs, which might sound surprising given all the economic doom and gloom. The truth is, the UK market is being pulled in two directions. On the negative side, the economy is clearly slowing, and inflation remains stubbornly high. On the positive side, the Bank of England's monetary policy remains broadly accommodative, and liquidity is still flowing into equities. Another big factor to consider is this: most UK-listed companies earn the majority of their revenue overseas. That means their performance is tied closely to the global economy, especially in America. With US stocks still trending upward, the spillover could potentially keep the FTSE supported. To put it simply, a full-blown stock market crash in the UK is highly unlikely. Instead, we may see slower growth and more sector rotation, especially in areas that could face tax increases in the upcoming autumn budget, such as banking, real estate, and gambling. The last factor is the bond market. Yields on UK 30-year gilts have surged to their highest level since 1998, driven by weaker demand from pension funds and fears about government debt. But here's what most headlines miss. The Bank of England has already taken steps to stabilize the market. It has cut the scale of quantitative tightening from £100 billion to £70 billion, and the Debt Management Office has reduced the share of long-term bond issuance from 20% to just 10%. That means supply is falling, which helps push bond prices up and yields down. This means that in the short term, yes, yields may stay elevated. However, the risk of another bond market collapse like 2022 is extremely low. By the way, if you're enjoying this breakdown so far, be sure to give this video a like. Now let's zoom out and look at the fundamentals. The UK's debt levels have climbed sharply, with gross government debt reaching around £3 trillion, up more than 75% over the past decade. That's not great news, but frankly, it's not catastrophic either. Meanwhile, GDP growth in the first half of 2025 has actually been stronger than many expected, with 0.7% in Q1 and 0.3% in Q2. Retail sales have also picked up, and the services sector, which drives most of the economy, remains in expansion territory. Inflation remains high, but most of the recent price pressures from energy and taxes are temporary. As energy prices stabilize and consumer demand cools, inflation is likely to ease gradually in the coming quarters. And finally, the Bank of England's policy path looks cautious, but consistent. After cutting rates from 5.25% to 4%, it's likely to pause before continuing toward an eventual 3% target by 2027. With all that said, is the UK economy collapsing? Nah, not even close. The UK is slowing and not sinking. The pound is stable, the stock market is still climbing, and bond yields are likely to moderate. What the UK is experiencing now is mild stagflation, but it's far from a triple slump. For investors, this means one thing: volatility may continue, but opportunities remain. The key here is to focus on selective exposures, such as sectors tied to global demand, while avoiding over-leveraged and heavily taxed industries. If you can see past the noise, that's where the real opportunity lies. Hey, if you found this analysis helpful, make sure to like, subscribe, and turn on the notification bell for more deep dives into global markets and economic trends. We'll see you in the next one.